So think back for a second. When was the last time you actually bought a toy?
Oh, man. That's a good question.
Right. And like, if you did buy one recently, was it for a kid or, was it actually for yourself?
Yeah, increasingly it's probably for yourself, which is...
Exactly. Because the entire toy industry is kind of going through this massive identity crisis right now.
Oh, absolutely.
And today, we're doing a deep dive into Mattel's Q1 2026 earnings call. We've got the official transcripts, the management guidance, the whole thing.
Yeah, the raw data.
Right. And our mission here is really to cut through all that Wall Street jargon and figure out if Mattel's this really ambitious transition from being just a legacy toy manufacturer.
Getting plastic stuff in boxes.
Yeah, into this like massive IP-driven entertainment machine. We want to know if that's actually paying off.
Because it's a fascinating pivot. I mean, you've got a company founded back in, 1945?
Yeah, roughly around then.
And they are trying to completely rewrite their corporate DNA for 2026 and beyond. They're looking at, movie tickets, digital downloads, high-end collector stuff.
But rewriting your DNA does not come cheap.
No, it really doesn't.
And that's exactly what this latest earnings call reveals. So for anyone out there holding this stock, or if you're just like interested in how massive legacy brands survive today, this is essentially the ultimate case study.
It really is.
Let's start with the headline numbers, because to understand this earnings report, I want you to think about flipping a house.
Okay, flipping a house. Tell me more.
So you drive up to this flipped house, right? And the curb appeal is just fantastic.
Fresh paint, new landscape.
Exactly. It looks great from the street.
Yeah.
And that curb appeal, that's Mattel's top line revenue right now.
Right.
In Q1, their net sales grew 4% as reported. Or if we look at constant currency.
Which just means stripping out the noise of like global exchange rates.
Yeah, exactly. It grew 1% in constant currency. And gross billings grew 2%.
So from the street, people are buying the product. Overall demand looks solid.
Right. They maintain their number one spot globally in dolls, vehicles, infant toys.
Mm-hmm.
But
there's always a but.
There's always a but. The problem hits when you actually walk inside the house, look at the budget, and realize the renovation has completely drained the bank account.
Yeah, the profit side of this report is, it's where things look pretty intimidating.
Definitely.
I mean, their adjusted earnings per share, the EPS, it declined 18 cents down to a loss of 20 cents for the quarter.
Which brings us to that massive number, a $70 million adjusted operating loss.
70 million.
Yeah. And just to put that in perspective for you, in the same quarter last year, that loss was only $8 million.
Wow. That's a huge jump.
Right. And the number that's really jumping off the page for all the analysts is the margin. Their adjusted gross margin dropped 460 basis points. It's down to 45.1%.
Which, for anyone not staring at a Bloomberg terminal all day, a drop of 460 basis points just means 4.6 percentage points.
Right. And in the manufacturing world, losing almost 5% of your profit margin in a single year.
It's a bloodbath.
It is a massive bite out of profitability. So what is squeezing them so aggressively?
Well, management was actually incredibly specific about the math here. They blamed this squeeze on basically a cocktail of macroeconomic headwinds.
Okay.
So over half of that margin drop, like 2.4 percentage points of it, was entirely due to global tariffs.
Just tariffs.
Yeah, just the gross incremental cost of tariffs.
Which is, that's an external geopolitical factor completely outside of Mattel's control.
Exactly. And then you stack on another 1.4 percentage points of unfavorable foreign exchange rates, and then another 0.9 percentage points from just general inflation on materials and labor.
So they're just getting hit from every angle.
Right. They managed to offset like a tiny fraction of this with some internal cost saver, but the sheer weight of the tariffs and inflation just crushed their margins for the quarter.
I'm still kind of hung up on that $70 million loss, though. Yeah. Like, it feels like that should be setting off major alarm bells across the financial sector. Why aren't investors just aggressively dumping the stock over a drop like that?
Well, to understand the market's reaction, you kind of have to look at the actual mechanics of the toy industry.
Okay.
Think of a toy company like a ski resort.
A ski resort. Okay, I'm tracking.
Right. So during the summer, a ski resort isn't really making any money.
No, they're just like running the basic maintenance.
Exactly. Keeping the lights on, waiting for the winter snow to actually generate the real revenue.
Right.
The toy business operates on that same extreme seasonality. The first quarter is their summer.
Oh, because everyone just bought all their toys in December for the holidays.
Exactly. So since the total revenue pool in Q1 is just comparatively tiny, minor dollar changes in costs cause these wildly exaggerated swings in the margin percentages.
Ah, I see.
A small tariff hike looks totally devastating in April, but it gets absorbed much easier in November when the sales volume is huge.
So management is essentially communicating that this was an expected seasonal trough, not some structural collapse of the whole business.
Exactly.
Okay, so the macro headwinds are eating the profits, but that curb appeal, the top-line sales growth, is still holding up.
Right.
If tariffs are squeezing margins, we have to look at what's actually keeping the top-line revenue afloat. Like what physical products are actually flying off the shelves and what's gathering dust.
Well, the divergence here between the product categories is pretty stark. On the winning side, vehicles are just an absolute powerhouse.
Yeah, up 13% globally, right?
Yep. Driven really heavily by Hot Wheels and the Disney Pixar Cars brands. Car culture just seems, I don't know, virtually immune to economic downturns.
It really does.
Yeah.
But then on the flip side, some of their absolute classic legacy categories are struggling hard.
Yeah.
Like dolls declined 11%.
Right.
And management attributed that mostly to Barbie, even though the Monster High brand actually showed some growth.
Which, we really have to assume is the inevitable Barbie hangover.
Oh, totally. You simply cannot sustain the level of peak global pop culture saturation they had with that movie indefinitely.
Right. The pendulum eventually has to swing back.
And the other major drag was the infant, toddler, and preschool category. That declined a steep 18%.
18% is rough.
It is. This is primarily Fisher-Price, which management actually admitted is acting as a 2 to 3% headwind to the entire global business this year.
Wow. Why is Fisher-Price struggling so much, though? Is it just a cyclical lull, or is there something deeper happening with how parents buy baby stuff?
It's likely a combination of macro factors. I mean, birth rates in a lot of developed markets have been steadily softening.
Oh, true. So the total addressable market of new babies is actually shrinking.
Exactly. But more importantly, inflation has severely pinched new parents.
Yeah, everything is so expensive.
Right. Big, expensive plastic baby gear is usually the very first thing cut from a household budget when groceries and housing costs spike.
That makes total sense. They might buy a small necessity, but they hold off on the massive playsets.
Yeah. And Fisher-Price is struggling enough that management noted they are executing a strategic review to figure out how to, maximize its potential moving forward.
Which is corporate speak for, we need to fix this fast.
Pretty much.
Yeah.
Now, even in that dark spot, the Little People brand actually grew double digits.
Oh, nice.
But we really need to talk about the breakout star of the quarter. It wasn't an action figure. It wasn't a baby toy.
What was it?
It was a segment Mattel calls challenger categories, which jumped an incredible 17%.
17. Wow.
And the massive driver here is something called the Mattel Brickshop line.
Ah, right. The building sets. This really represents how Mattel is fundamentally rethinking who their customer actually is.
Yeah.
Because the building sets category, the interlocking bricks, is one of the fastest growing and highest margin parts of the whole toy industry.
Which has obviously been completely dominated for decades by Lego.
Exactly. But Mattel realized they have total dominance in car culture with Hot Wheels, so they basically married those two concepts to attack a totally different demographic.
And the way the executives describe these sets on the call is just amazing. They aren't treating them like toys at all.
No, not at all.
They're treating them as premium adult collectibles. Like, they feature die-cast metal parts, real rubber wheels. They even describe the instruction manual as being library quality.
On library quality, I love that. Because they aren't selling to a 6-year-old.
No.
They're selling to a 35-year-old professional who has disposable income.
Just picture, a guy named Kevin in corporate accounting demanding leather-bound instructions to build a toy car for his desk.
It's brilliant.
It really is. These are high-margin, premium products that are completely insulated from the inflation squeezing new parents.
Right.
Management explicitly stated they're actively chasing demand for the Brickshop line. They can't make them fast enough.
And they expect this to be a multi-year growth engine.
For sure. But, that physical product innovation is crucial, but it's really only half of the top-line story here.
Yeah. The other major driver is their massive digital leap.
The gaming side.
Right. Mattel just spent $75 million in cash to acquire the remaining 50% of the Mattel 163 joint venture.
So they fully own it now.
Fully own it. They are integrating it to launch self-published mobile games, starting with a Masters of the Universe game that is currently in soft launch.
Okay, I am going to push back hard on this digital strategy, though.
Okay, let's hear it.
The mobile gaming market is notoriously saturated. Like, user acquisition costs, the money you have to spend on Facebook or Google ads just to get someone to download your app are sky high right now.
They are.
So why is a legacy toy company playing in this incredibly expensive cutthroat sandbox?
Well, the analysts on the earnings call actually cornered the CEO on exactly this point.
Oh, really? Good.
Yeah, but the economic counterpoint the CEO offered is actually pretty compelling. First, he pointed out that the actual development cost barrier has plummeted recently.
How so?
You don't need to own a massive studio or build a custom game engine from scratch anymore. You can fund the development of a top-tier mobile game for single-digit millions now.
Okay, fine. Building the app is cheaper than it used to be. But building it isn't really the problem.
Getting players is the problem.
Exactly. Getting noticed in an app store with 2 million other games is where companies bleed cash. If they don't spend $50 million on marketing, no one will ever download the Masters of the Universe game.
And that is usually the killer for indie studios, right? But this is where Mattel's IP moat totally changes the math.
Okay.
They don't have to pay those exorbitant marketing costs to acquire users because people are proactively searching for their brands anyway.
So the search volume is already there.
Exactly. The CEO brought up two killer data points to prove this. First, they put a Barbie-branded game on Roblox.
Okay.
And it was a top game on the entire platform for over a year with zero marketing spend.
Wait, absolutely zero.
Zero marketing dollars. And then, when they launched a Uno experience on Fortnite, it became a top 10 experience on day one.
Wow. But I guess my question is, does a year on top of Roblox actually translate to high margin revenue? Are these players actually spending real money? Or are they just playing for free?
Oh, they are spending. And because Mattel didn't have to spend a fortune on user acquisition, a much larger percentage of those in-game microtransactions drops straight to the bottom line.
Oh, that makes sense.
Their economic equation is fundamentally different from a random gaming studio because the global brand awareness was already paid for, decades ago.
Right. They're cashing in on basically 80 years of brand equity.
Precisely.
And that built-in audience advantage is the perfect bridge to their broader strategy because Mattel isn't just going digital.
No, they're going full Hollywood.
Full Hollywood. This is the core of their entire transition. They're investing heavily. We're talking $150 million in 2026 alone, just to accelerate this IP-driven growth.
It's a very deliberate shift from being a toy manufacturer to becoming a franchise management company.
Yeah. I look at this and I honestly see the Marvel model.
The Marvel model.
Yeah, so if you go back to the late 90s, Marvel was a company that sold comic books.
Yeah.
And they were literally going bankrupt doing it.
Right.
Now, the comic books are basically just the research and development department for a massive cinematic and merchandising universe.
Oh, totally.
Mattel is doing the exact same thing. They aren't trying to just sell you a He-Man action figure anymore. They're selling you a theatrical experience, a mobile game, and a premium collectible simultaneously.
That ecosystem approach is the ultimate goal here. Management stated they are aggressively moving away from promoting individual toy lines, and they're shifting toward holistic brand marketing.
Because if you do it right, success in the toy aisle breeds success in entertainment.
Exactly. And then that entertainment success inflects right back onto toy sales. It creates this self-sustaining loop.
And the big test of this ecosystem loop is coming up fast. They have the live-action Masters of the Universe movie releasing on June 5th.
Right, distributed globally through Amazon MGM.
Yeah. And management expects this movie to drive double-digit growth for the entire brand.
I mean, the specific word they used on the call to describe the movie is just fantastic.
What was it?
They called it toyetic.
Toyetic. That's so good.
It's a brilliant industry term. It basically means the movie's visual design, like the vehicles, the weapons, the character costumes, naturally translates into fantastic physical merchandise.
So they are actively designing the cinematic universe To look good on a retail shelf.
Yes, and they are backing this up hard. They rolled out a full cross-category product line this past weekend. Mainline toys, adult collectibles, apparel, publishing, you name it.
And it doesn't stop with He-Man either.
No, not at all.
They highlighted a Matchbox movie coming in October, plus a massive slate in development. Hot Wheels, Polly Pocket, Barney. They even have a Rock'em Sock'em Robots movie.
It is just an all-out assault on the box office.
It really is.
Yeah.
But all of this Hollywood development and digital game publishing takes massive upfront capital, which kind of circles us back to the financials. With all these expensive investments squeezing those Q1 profits we talked about earlier, what is management promising the investors who are actually footing the bill?
Well, looking at their guidance for the rest of the year, they are definitely projecting a rebound.
Okay, that's good.
In the short term, retail ordering patterns in the U.S. are finally stabilizing. They had been navigating some complex shifts with retailers, holding less inventory, but Q2 shipping is already showing acceleration.
Nice. And for the full year, 2026, they are officially reaffirming their guidance of 3 to 6% net sales growth.
Right.
They expect those battered gross margins to improve sequentially in Q2 and the second half of the year, ultimately hitting approximately 50% for the full year.
Which is a strong target.
It is. They're projecting adjusted EPS between $1.27 and $1.39. And crucially, to keep Wall Street patient during this really expensive cinematic transition, they're returning cash to shareholders.
Yeah, they're planning $400 million in stock buybacks this year alone.
$400 million. They even teased 2027. Projecting mid to high single-digit revenue growth and strong double-digit growth in adjusted operating income.
So on paper, management is projecting absolute confidence that the strategy is working.
On paper, yes. But if you read between the lines of the Q&A portion of this earnings call, what are the executives secretly sweating about?
Oh, they're definitely sweating.
Right. Like that 50% margin goal sounds great, but what are the actual risks that could derail this very confident guidance?
The caveats were definitely there. Analysts pushed them really hard on the macroeconomic risks.
And what's the biggest vulnerability?
Supply chain, without a doubt. Management admitted they are heavily monitoring the conflict in the Middle East, specifically how it impacts ore prices and global freight costs.
And this is a critical point to understand about the business of making toys. The entire industry is just deeply tethered to petroleum.
Right, because plastic is literally a petroleum derivative.
Exactly. So when oil prices spike, the raw material cost of, say, a Hot Wheels track just spikes along with it.
Yeah, but it goes even deeper than the plastic itself. Think about how toys are shipped.
Right, the logistics.
You're manufacturing these lightweight plastic items in Asia, putting them in cardboard boxes and shipping them in massive steel containers across the ocean to U.S. ports.
You are essentially paying to ship a lot of air.
Exactly. So if freight costs spike because container ships have to, reroute around conflict zones in the Middle East, the profit margin on a $20 toy vanishes instantly.
And then you add the tariff situation back into that mix, and the vulnerability is just huge.
It is. Management was very careful with their wording regarding tariffs.
I bet.
They stated there has been minimal impact to date on consumer demand and that their current guidance includes a range of scenarios, but they plainly admitted, quote, "We are not immune."
Right. If geopolitical disruptions drag on, or if the tariff situation escalates, hitting that 50% margin goal for the year becomes an incredibly steep climb.
It really does.
So let's bring this all together for the bottom line.
Let's do it.
What did this mean for you as an investor, or even just as a consumer, watching this brand evolve?
Well, Mattel is in the middle of a very expensive, high-stakes transition.
Yes, they are.
They're evolving from a pure physical toy manufacturer into an IP franchise machine. And in the short term, the growing pains are very real.
Just look at the squeezed Q1 profits and that $70 million operating loss.
Exactly. But the strategy is undeniably driving top-line growth in some highly profitable new avenues.
Like the self-published mobile gaming with built-in audiences.
Right, or the premium building sets for adult collectors.
Right. So if you are evaluating this stock, Mattel right now is basically a masterclass in modernizing a competitive moat.
I completely agree. They recognize that relying solely on selling plastic toys to young children was a shrinking demographic strategy.
Because birth rates are down, and kids are aging out of physical toys faster than ever.
Exactly. So they're aggressively expanding their demographic. They're chasing nostalgic adult collectors with the Brickshop line, and they're targeting digital natives on Roblox and mobile platforms.
Which brings me back to that fantastic word management used, toyetic.
Such a great word.
It makes me think about our opening question regarding who toys are actually for anymore.
Yeah.
As our entertainment becomes increasingly virtual, with kids spending hours of their playtime building digital worlds inside Roblox and Fortnite, we're looking at a radical shift in physical play.
We really are.
Are we approaching a future where physical toys eventually become luxury collectibles strictly for adults?
It's a profound cultural shift. The physical object becomes like a nostalgic centerpiece for someone's desk rather than a plaything for the living room floor.
A library quality instruction manual for a miniature car.
Exactly.
Meanwhile, the next generation's definition of a toy might exist entirely behind a glass screen, driven by microtransactions and digital IP.
It's entirely possible.
It really makes you wonder, 10 years from now, when Mattel releases their Q1 2036 earnings, what will a trip to the physical toy aisle even look like?
Will it even exist?
That is the big question.
Definitely something for us all to ponder.
Absolutely. Well, thanks for diving deep with us today. If you hold the stock or are just watching the transition, there's a lot to keep an eye on. We'll catch you on the next one.